Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and/or financial topics. We're going to dive right in, take a look, and see what people are sharing. If you want to follow me, it's at Finding_Finance. And if you want to join our community, finding-value.com, that's where I dive deeper into all of these topics that we discuss. We've got platinum question and answer sessions on the weekends where I interact directly with members. And then I give midweek updates on basically all of the companies that we are looking at. I am a long term investor. I look for opportunities for investment when companies are down. I invest into those companies and ride it for the long term. My 5-year average, compounded annual growth average of the past 5 years is 41%. It's probably going to be a little bit lower than that this year, as some of my stalwarts, we'll call it, in the portfolio are not up that amount. And it will cycle. It will go up, it'll consolidate, it will go up, consolidate. And that's kind of the trend that I see in there. So I don't try to time the market, time it as in buy and sell. I try to time my purchases and try to just let everything ride. If that's something that you're interested in, you're not trying to play the short term trading game and you're playing more for long term compounding growth, then yeah, I think it's probably a good fit. Mayday coupon code is active if you'd like to join. MAYDAY, one word. 50% off the first month and a larger discount for those looking for a yearly membership. All right, so we've got Dan Murphy here. It says, too much doom and gloom. OPEC chief is bullish on oil demand despite extended production cuts. I think they extended those production cuts because the price of oil has been pretty low. In fact, again, if you use that dot plot of commercial inventory versus historical oil price, oil should be priced in the mid 80s. Mid 80s would be a fair value. Overvalued would be in the 90s, and we are undervalued in the 70s. And I do see that oil is up today, which is November 4th that I'm recording this. Another thing to think about is when they extend these production cuts, they are actually giving us an opportunity to buy certain sectors that transport those, the oil. I know we've had a little bit of a run up in oil transporters, is what I'll call them. A little run up before because we thought OPEC was going to come back and um, increase production, which means you have to ship it around the world. But with these production cuts, you can see those companies are pulling on back. And I think it's going to be one heck of an opportunity for an entry point. That's what I think. Coming out of Nostra, he says it currently costs $81.4 thousand to mine a single Bitcoin, only worth 67.6 thousand. Think about that. Now, with these halvings continuing to occur, it's going to get harder and harder to mine Bitcoin. Now, what happens if we get a big move lower in Bitcoin? Like, let's say Bitcoin's only worth $30,000 and the mining costs are 81.4. Now, some people say that the difficulty adjustment will take that into account. Well, why isn't it taking into account right now? So we need people to literally lose. We have to lose miners in order for that adjustment factor to kick in. I don't know, but it's an interesting thing to watch. Mining costs and these halvings versus what the price of Bitcoin is. Very interesting thing to watch. JC Parrott says, for me, it's less about the Brazilian real ripping over 1.8% today and more about from where the Brazilian real is ripping over 1.8% today. And we're coming from a really low level and a potential double bottom. Could this be a bottom? Now, why does this even matter? Why do currencies even matter? Why am I even talking about this? Well, some of our investments are predicated off of the dollar weakening. And they also are predicated off of currency exchange rates going up over time. Now, I'm not solely relying on the currency exchange rates to be 100% the investment because they also sell commodities where I think if the absolute dollar strength goes down, we'll still benefit, but it will be a bigger benefactor if the currency of that commodity company that they trade and transact in goes up. When the Brazilian real went up last bull market from 2002 to 2011, there were companies that went up many fold. And when I mean many fold, I'm not talking 1, 2, 3, 4, 5x. I'm talking like 50 to 100x from their bottoms. And we are very close to the bottom in some of those. And the reason that we are close to those bottoms is because we're staring at it right here on the screen. The Brazilian real has been going down, the dollar's been strengthening, and I think we could be potentially be doing a double bottom here. And this is your entry point given this. Now, if we start to move on up, all things good, and you've got one heck of a leveraged play to the Brazilian real. Eric Yoon says, physical gold has gone from the weak hands to the strong hands in China. This is probably happening worldwide as well. And it says, a consumer said when gold skyrocketed to 520 yuan per gram, I gradually sold my gold. Now it has risen to yuan 630 per gram, and I have no more gold to sell. Gold is still rising. I have lost gold. A few people bought gold and stacked it. The market data on November 4th from SGE SFE for China. So they're trying to time the market. They're saying when it goes up, I'm going to sell into strength and I'll buy it back on weakness. What if the weakness doesn't come for a long time? What if gold goes to 1,000 per gram or 1,000 yuan per gram? And that's the difficulty trying to time short-term market movements. You want to size the big move. And if you can size the big move up, that is where the big money is made. So sizing the big move, being patient, accumulating when it's cheap, and then riding the entire big move. Very few people can do that. Now, how big of a move do I think this could potentially be for gold? I don't think we are anywhere near a potential peak. In fact, I think that we are still closer to a bottom than what we are to a top. And I think the top will probably occur somewhere in the 2030s. It could be early, it could be mid. I'm not exactly sure the exact timing of it, but I think somewhere in that general area. The top is going to be way up there. So people are trying to time the small little wiggles, doing the little wiggles there and trying to gain a little bit of, a little bit here and there in terms of maybe double-digit percent gains. But I don't look at it like that, guys. I look at it as a protection against my government, a protection against currencies, a protection against inflation of those currencies, a protection against theft in terms of taxation, a protection against them changing their minds and taxing 401ks potentially. Who knows what kind of stuff's going to come out? But that is what I'm protecting against, and I don't want to be in the system. So gold is one of those avenues to get out of the system, and that's why I never exchange it for paper currency again. So unless I need to pay something off in paper currencies, there's no reason for me to exchange it. So that's where I do the ratio investing. I swap between metals. I carry more of the undervalued metal, and I ride it up with a portfolio full of metals. I don't have to time crap because I'm in a metal and I'm protected against currency depreciation. And that's everything. And if you guys want to learn, we can talk about how to do this, what it's like to go to a dealer and exchange the metals. How does it work? I can tell you the requirements that are there for dealers on 1099s and all of those things. And you can become a well-informed investor in how to do this stuff. But I just see it as a huge taking small gains and transacting back to currency. I just see as a mistake. I don't want to do that. Logan says key loan to value data was near 85% back in 2008. Over 23% of homes were underwater in 2010. Today, the loan to value data is under 50%, and we have the smallest percentage of homes underwater in history. 40% of homes have no mortgage debt either. Guys, we are ultra strong in the housing market. These people that are talking about 30% pullbacks are sniffing the white stuff. Yeah, cocaine's a hell of a drug, is what I'll say. They're sniffing the white stuff. They don't know what they're talking about because you can't have a housing crash with no forced selling at all. You really need forced selling for a big market crash. And these guys talking about 30 to 50% declines, those are big market crashes. Now, what I think will come is my guess is that interest rates will fall. That is my guess. And I think house prices will remain robust. And they need the taxation from those houses going up. Remember about who's collecting all the taxes. Coming down to lumber. So housing. So if housing was going to have a 30 or 40% decline, tell me why lumber has broken out convincingly on the shoulder head shoulder to the upside. And to me, looks like we're putting in a bottom and a base from 2023. That white stuff kills brain cells, guys. At least I think it does. I don't actually ever, I never actually researched that. I'm sure it does. But to me, this looks like a bottom. Lumber's going up. Lumber is generally what precedes a big bull market or move in home builders. So this is one to watch. And I have this up here to talk about, all these people who think that the housing market's going to have this gigantic crash. I just don't see how. That's like saying we're going to get a crash in uh, whatever commodity, but we don't have any inventory of the commodity. It's like, well, you can't crash then. I don't know. It just seems obvious to me. Nostra says U.S. Treasury has temporarily lifted sanctions on Russian banks so that U.S. companies can import commodities from Russia. Yeah, it's getting that bad. Of course, guys, we can't do anything because we don't control all of the commodities. Russia's got a buttload of platinum group metals. They've got a lot of oil, and they don't want oil to go up. So if you're trying to manipulate all this crap, they're going to need Russia. And I'm sure Russia knows that. I heard that President Putin over in Russia has a PhD in energy economics or energy finance or economics, whatever it is. I think that's pretty impressive, to be honest. That's pretty cool. Break wave, we got freight futures AM update. Dry bulk, Capesize is up 3%. Panamax is up 2%. Tankers are down 2%, and Suezmax is flat. And remember what we talked about earlier. OPEC is keeping those production cuts going into the future. So we're going to see tankers probably pull back, and I think there's some good opportunities here. And even dry bulk is looking pretty bulky here, if you know what I mean. Investment wisdom: leverage is the only way a smart guy can go broke. If you owe money and you can't pay it off, just pay for everything. Do smart things, and eventually you'll get rich. And what generally occurs, there's a couple of things that I think leverage does. If you start leveraging up too much, you're going to get impatient. You're also going to be looking at your account value because if it goes down, you could potentially get a margin call depending on how far it can go down. And you don't want to sell your investments and assets at the bottom, which margin will force you to do. So you want to be able to hold through whatever comes through and play that big bull market. And leverage can kill you if you take on too much leverage. Now gold equals 1. He says, while I'm not selling a thing, I would not be at all surprised to see gold springboard off the apex of its long-term rising wedge around 2150. A pullback of a little more than 20%. Gold was at this level just 9 months ago. So it really isn't as shocking as it seems. Did we get a pullback? I don't know, guys. It doesn't matter. It really doesn't matter. I've been in the game long enough now, and I've seen all these pullbacks. Just size the big move. Size the big move. Use the pullbacks for additional buying opportunities. They have a saying for it: buy the dip. That's what it means. Buy the dip in a bull market. So everybody who's worrying about these short-term market movements, and I read stuff on Twitter here where people are proclaiming like, "Oh, they nailed this short-term move. Did you see what I expected out of the market?" I just think that's all stupid. I just it's like, what are you doing here? You're trying to time a 10% move. Did you know that timing a 10% move isn't even beneficial? Because if you have short-term taxes and you're paying 20 something plus percent on taxes, you need a 20% plus pullback in order to make that money back up, in order for it to be worth the sale. And I don't even think people understand that. I mean, that's what your tax rate's going to be on a short-term gain. And that's if it's an equity. In gold, you could say it's a collectible. And GLD, I think, is treated as a collectible when you trade it. So I don't know. I mean, I look at that and I'm just like, good luck, guys. Good luck with your short-term trading. I just don't think I don't think they make that much money in real terms after you strip out all the taxes. If you want to do stuff, and the way that some of the big boys do it is they buy a bunch of stock when it's cheap and then they just hold on for a very long time. They do take loans against the stock if they need it for something, but they don't want to sell the stock and take um, and have to pay taxes on it. So a lot of really rich people, they buy stock, they hold it for a really long time, they collect dividends from it or payments from it, and they don't want to sell it, but they can borrow against it. And that's some of the things that they do. WCTW, ignore geopolitics, focus on oil fundamentals. This is OPEC plus crude exports, pretty low compared to some of the other years before it. They're not pumping a bunch of exports, and this does have an impact on tankers compared to some of the previous years. This is 2023. The green is 2022. So 22, 23 was above. And then we also had an increase in 21 towards the end of the year. You can see we went from left to right on 2021. Here's Grady. He said, post this chart back in late 2023 saying the U.S. bonds look to have bottomed at the orange dot. Said back then that this has huge implications, e.g., falling rates is bearish USD, rolling over since then as expected. And now US bonds has higher high after the major low in late 2023, i.e., US bonds has now confirmed a trend change to the upside, and that fits with Fed's further coming rate cuts and USD dropping. When these charts turn big picture, next time though, we have to be prepared for what's coming. And he's got Fed would probably try to save the bond market before the US dollar. But the global leveraged debt mountain will probably take down bonds anyway. If this chart plays out, it would probably mean the destruction of the US bond market. QE infinity is coming on this side here, is what he's saying. Yield curve control is what's bringing that back down. I called the crystal clear false breakout, blah, blah, blah there. So that is probably what's coming. We could see a move lower in TLT, bond prices eventually, and that's when they do QE infinity. That's when we hit problems or bank problems or whatever the problems are. Coming down to Logan, new listings data this week, 60,819. New listings back in 2009 were 280,000. 2010 was 353. 2011 was 352. Stop dancing with a ghost. And that's in response to these guys who are very bearish in the housing market. We just don't have big volumes coming through. So we don't need a ton of sales if the volumes drop because we don't have the listings. We don't have the volume. And that's where I'm going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you're interested. And we'll catch you guys later. This is Finding Value.